Hey everybody, can you see me? All right, I see the love. Thank you. Let me share my screen here. So thanks for coming, thanks for attending, thanks for joining me. Welcome to the 2-hour crash course on options trading. I am so excited that you guys are here. So if you're here, please pay attention, put your distractions away. I turned my phone off, turn your phone off because I'm here for free and I'm here to share all the cool stuff about options trading, selling puts, selling covered calls. So just to start off, I'm Michelle Kinney. Nice to meet you guys. I want to let you know who I am, right? Because I think that's important. There's so many people on YouTube that really make money from just selling courses or monetizing YouTube. And fortunately, I'm getting a really good YouTube following. So I recently started monetizing it, but I've made money from trading. So I started trading literally in 1997. I was 23 years old. Don't do the math on that. But I've been trading ever since. I started with commodity futures and options. I've traded professionally for about 13 years or so, from '07 to 2020. And I have exclusively made all of my income from trading since 2015. So all trading. And I feel blessed every day that I wake up and I don't have to go to some job I don't like or go work for some boss who doesn't treat me right. And it's my conviction that I want to help as many people as possible really follow in my footsteps and do the exact same things. So you can either create a side gig for yourself if you're already working, or if you don't want to work anymore, depending on how much capital you have to start, you can literally do exactly what I'm doing. I do what I want when I want, and it feels amazing. So I'm here to teach you just these two strategies. So I put together some slides. I do want to start by saying I'm not a financial advisor. I'm not going to recommend anything specific for you guys. Sometimes I put things on YouTube, different trade ideas and things like that, but I don't want people to get mistaken or misunderstand that I'm recommending something to you specifically. Listen, your money is your money. You got to take responsibility for your own self. I'm here to teach you and guide you and help open your eyes to different ideas and kind of walk you through the steps. So that's what my role is. The stock market does have risk. There's always going to be risk in the market. You can lose some of your money, you can lose all of your money, but I'm here to help you not do that, obviously. It's all about risk and figuring out what the risk is and understanding it and mitigating it, right? Minimizing it as much as possible. First of all, before I want to really get too far, I want to say, like, first of all, pat yourself on the back for even being here. There are so many people that I talk to on a regular basis who say that they want to change their life or they want to start trading or create income. And they say all these things, but they don't actually take any action in order to do that. So congratulate yourself for being here. I think that's great. Who this is for, you don't need any experience. So if you're in the audience and you never traded stocks before, you don't even really maybe know what they are, you really don't know what options are, but regardless of whatever situation you're in, you are in the right place. I'm going to make it so easy for anybody to understand. I'm not going to use lingo. I'm just going to talk to you like a regular person. And this stuff is not hard. A few years ago, I did a session at my kids' school when I lived in the Virgin Islands. And if I can teach, I don't remember what they are. I think they were like 10th graders. If I can teach 10th graders how to do this, I can literally teach anyone. It's not that hard. You might also, maybe you have a little bit of experience trading, but you're not getting the results that you want. You're in the right place. If you want to make money every single week, you are in the right place. That's how I support myself. Listen, I'm not all about like, I'm going to buy some stock and I'm going to wait and pray and that goes up and sell it in 6 months and make money. No, this is about making money each and every single week. Why? Because you need cash to do the things that you want to do. You want to go out to dinner, you want to pay your bills, you want to pay your car payment or your mortgage or go to the grocery store. You need cash to do that. So that's what this class is going to be about. All really you need some drive and determination. So you need the intention to say, you know what? These are two strategies that I'm going to learn, selling a put, selling a covered call, and I can do that. That's all you need. I want to take a minute and say who this is not for. So if you're a gambler or you want to talk about like, I think blah, blah, blah is going to go up next week and I'm going to make some money or 10x my money or something like that, this class is not for you. I am not hitting like home runs on trades. I'm not looking to invest $100 and make $1,000. That's not what this class is for. That's not what these strategies talk about. I'm talking about just hitting singles, right? I just want to keep hitting singles, maybe sometimes walk the bases and win the baseball game. So all the trades are all about minimizing risk and just taking in realized gains all the time, week to week. So that's what we're going to talk about today. So there's different ways to make money, right? So I want to just kind of go through this briefly as we get started. The most common thing that people talk about in the market anyway is buying stock, right? So I buy some stock in ABC company or whatever the case might be. That is a fundamentally broken system because first of all, you can only make money if it goes up, right? So if I buy stock, I can only make money if the share price goes up, number one. And number two, I can't actually put any of that cash in my pocket until I sell my stock, right? So I don't know, how many of you guys out there have traded stock? Just raise your hand. Traded stock over the years? And you buy stock and the stock goes up and you feel really good and you see that number grow on your statement, but you can't spend any of that. The same thing is applicable for crypto. I like crypto. I'm a big believer in Bitcoin and Ethereum and all these things, cryptocurrency and blockchain in general. But the big problem with that, it's the same thing. I buy some Bitcoin, I can't spend that unless I sell it. So what else is there? So that's why we're going to talk about options, because options gives you cash as you go. Another thing, it's funny. I was, because I'm trying to like amp up my YouTube. Listen, I'm here to start a movement. So here's my, and sorry if I say the F word, my daughter's looking at me funny. Um, here's my thought process. Wall Street has people like hypnotized and tricked into thinking that you need a financial advisor. You can't make 100% per year. You can't do it yourself. It's like it's all not true. So I see a lot of these like YouTube channels that talk about like day trading. I don't know. I was like looking at this TJR thing on YouTube that my son was telling me about recently, and it's confusing. Like day trading, like who wants to day trade and sit in front of like a computer screen all day? Listen, I trade to live. I don't live to trade. In other words, what I mean by that is I trade to provide me the lifestyle that I want to do. Literally, these strategies, once you learn them, and it doesn't take that long to learn them, I always say it takes about 6 hours, 8 hours to get a good fundamental understanding, and then practice making trades. And once you have those fundamentals under your belt, literally it takes like 15, 20 minutes a day. And if you don't have it every day to do, that's okay too. Like I'm not looking at my computer screen all day, every day. That's not why I'm here. So day trading, if you want to day trade, this class is not for you. I would just put Amazon drop shipping. I kind of Googled like side hustle kind of thing. How can you make money? Because I wanted to just kind of compare these other ways to selling options. So that's what we're going to talk about today is only 2 strategies. Listen, so many people ask me credit spreads or I don't know, diagonals or all these crazy things that I don't even know what they are, honestly. You only need 2 strategies to be successful. How to sell a put and how to sell a covered call. We're going to go over both of these in this session today, right? Also, I want you guys to know, sometimes people think like you need a lot of money, a boatload of money to start. You definitely do not, right? So I always suggest that people start with at least $2,000 or something like that. Obviously, the more you start with, the more dollars you can make, right? Obviously, that's logical, right? But these 2 strategies, selling puts and selling covered calls, they work regardless of whether you have a big account or a small account. The only difference, really the only difference is what kind of stock can you trade, right? In this session, I'm going to show you a low dollar stock because I want people to not think that they need a lot of money. I want them to start off small. And I'm going to go through an example as we go through. So I want you guys to keep that in mind. 2 strategies, big accounts, small accounts. It doesn't matter if you have a small account, you just can't trade like big expensive tickers like Tesla or MicroStrategy or something like that. That's the only difference. I'm going to walk through exactly how to do that. I'm going to use my platform. So I've traded on different platforms over the years. Right now, mostly what I use is Schwab Thinkorswim. I'm not being a commercial for them, and I don't get paid if you open an account with them. But I'm just letting you know that that's the platform that I'm going to walk through with these examples. Now, if you trade through somebody else, your data is going to look a little bit different, but it should have all the same content, right? I'm going to show you with selling options how, number one, you get paid the same day. This is not like I'm going to buy some stock and I'm going to wait 6 months and I'm going to hope and pray that that goes up to make money. No, you get paid as soon as you sell a contract, and that money gets dropped into your brokerage account. That's super important for you guys to know. Another thing is I'm going to show you how you lock in your gain every single week. Here's the thing, and as we go, I'm going to kind of make some comparisons because I really want you guys to understand the big difference between selling options and just buying some stock, right? When you sell options, you lock in those gains. Here's the thing, guys. The market and stocks go like this. I look at any chart, any stock chart, nothing ever goes straight up or straight down. I mean, not usually anyway. What do? It chops around. It goes up, it goes down, etc. Over the long term, good stocks all go up. That's just the way it works. It's like the theory of relativity, or the theory of, I'm going to drop a ball from high in the air and gravity is going to make it go down. It's just how it works, right? And I'm going to show you that as we go through this presentation. Also, a cool thing about options is you don't only make money if the stock goes up. Listen, I'm not saying, hey, I think NVIDIA is going to go up next week, so I'm going to trade NVIDIA. Or I think Apple is going to go down next week, so I'm going to trade Apple. No, I trade the same stocks, and I don't really care what the price is, and I just trade it over and over and over again, week to week. So with options trading, you can make money if it goes up. You can make money if the stock goes down. You can make money if it stays sideways. It is literally a game changer. And here's the thing. I've had real estate off and on my life, and real estate is kind of cool, especially rental properties, Airbnb, that kind of thing. But here's the thing about options. You have no customers, no employees, and you can literally do it from anywhere in the world. I'm telling you, there's people, you don't even have to be in the US. I've had people from Europe. I've had people from Asia. I lived in Asia for a while. Actually, I lived there, Southeast Asia, for a couple of years. I lived in the Virgin Islands for a long time. You can be anywhere. It doesn't matter. You just need a laptop. Some people trade on a phone. I don't do that. I find that kind of difficult. You could do that perhaps. But this is, I'm telling you, bar none, this is the best gig in the universe. I don't know anything better than trading options. So let's just jump right in and let's start, right? So we're only talking about 2 things today: selling a put and selling a covered call. It might sound confusing if you don't have any experience. It's like anything else. Once you kind of, like, if you're not familiar with concepts, like let's say I want to learn Spanish, right? It's going to be a little confusing, and my words might get tripped up. I might be confused, but it's practice, 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 and learning and understanding the different words. This is the same thing. Here's a great kind of analogy on what it means to sell a put. This is actually really, really good. So someone else, let's say Jane Doe in Kansas, has 100 shares of Apple, right? So this Jane Doe has 100 shares of Apple, and she just has her shares, and she doesn't want to lose all her money if the stock crashes. What she does sometimes is she buys insurance in case the stock crashes. Very much like when I drive a car, I buy insurance in case I crash the car, right? This is the same thing, guys. What she does is she pays a premium to somebody, a premium just like your car insurance. I'm paying a premium to shift the risk over to somebody else. And And when she pays her premium, she pays it to me because I'm selling her the contract and I'm committing to buy her shares if her stock crashes, right? So that's all that selling a put is. So Jane Doe in Kansas City owns 100 shares of Apple. She doesn't want to lose all her money if her stock crashes. She wants to buy insurance. I sell her that insurance. She pays me money. I put it in my pocket and I keep it. I keep it regardless of whether her stock crashes or if it doesn't crash, because I'm going to buy her stock if it crashes. That is what selling a put is, just like car insurance. Now I want to talk about a couple rules before we jump in to show you an example on selling a put. You are only going to trade a stock that you like, okay? That you're okay buying at some particular price. Now, I wrote the strike price here, and I didn't talk about what that means yet, and I'll talk about that in a moment. But basically, you want to make sure that you are trading something that you like the stock, you think it's a good solid stock long term, you have enough money to trade the stock. We're going to talk as we go through this session how much money you have to put up to make the trade, right? Like, how does that work? And maybe you might use margin. We're going to talk about how that works as well. That's like borrowing some money from the brokerage. But really, you want to make sure just those two basic things when you sell a put or when you're trading a ticker, it's a stock that you like and it's a price that you want to buy it at, right? There's really only three things. So this stuff, I'm telling you, trading options is kind of like confusing just at the very beginning, because once you get the hang of it and once you start to kind of understand the different pieces, there's not that many pieces that you have to figure out. You're not going to have to like pull up different like indicators in your charts. You're not going to have to subscribe to these crazy things that give you different information, fundamentals, or looking at reports from companies. No, you don't have to do all that. You're going to choose what stock to trade, right? We're going to talk a little bit about that as we go. You're going to choose when you want that contract to expire. We're going to talk about that as well as we go. And you're going to choose the strike price. Now, when we're talking about selling a put, my example of Jane Doe, I think I said, in Kansas City, who has 100 shares of Apple and she wants to make sure she doesn't lose all her money if the stock crashes. So we want to choose the strike price is the price at which I'm okay buying her stock if it crashes, right? So let's say Apple right now is $100 per share. And I don't want to buy it at 100. Maybe I don't even want to buy it at 99 or 95. Maybe I'm only okay to buy it if it crashed all the way down to $80. So we are going to choose that. That's called the strike price. So we're going to go through that more. And I'm going to show you as we walk through my platform exactly what you're looking at. But there's only three things. The ticker, which is the stock that you're going to trade. Apple, Amazon, ABC, XYZ, whatever that is. When the contract expires, next Friday, the following Friday, this Friday, next month, etc., and the strike price, the price at which we're comfortable buying those shares. Okay, so let's just jump right in and look at an example. So I wanted to give you guys an example of a dollar value of a stock that's not that expensive, right? So like sometimes, I mean, my favorites are like, I love Tesla, I love MicroStrategy, but those are kind of expensive stocks and they're not for everybody. And also when people start, I think it's important to like start small, like baby steps, right? Like, learn to walk before you run, that kind of thing. So I'm going to use an example of ETHA. So ETHA, ETHA, it's an Ethereum exchange traded fund, right? So it's based on cryptocurrency. But I think ETHA is a good one to start because listen, cryptocurrency is not going anywhere. So I don't know, like let me see a show of hands, like who wish they bought Bitcoin when it first started, when it was like $5 or $50 or 500. Heck yeah, right? Everybody's raising their hand. What's Bitcoin at now? I think it's like 112,000 or something like that. And it's probably going to go to 500,000 and a million. And so my point is this, over time, it will go up. Ethereum is super big. So Bitcoin's the biggest, Ethereum is the second biggest. And so I thought ETH was a good example. It's only 29 bucks per share. So we're going to walk through an example of that. And what we're going to look at is selling a put, because first we're going to talk about selling puts. Second, we're going to talk about selling covered calls. The only two strategies, right? My intention, listen, all you guys are here for free. My intention is I want to start this movement. Like I love to see other people successful. Your success does not minimize my success, and it makes the world a more beautiful place. I truly, truly believe that, and that is not bullshit. So we're going to talk about selling a put on ETH. I'm going to walk through that with you guys. So thank you for the love and the hearts and the thumbs up and all. I appreciate that. As far as expiration date, I'm going to jump in and say this. So different stocks have different expirations. Now, the big ones, like the popular ones, the ones that are traded a lot, they will have expiration dates every Friday. This Friday, next Friday, the following Friday, etc. Some stocks that perhaps are not as popular don't have expiration dates every week, but they might have every month, right? I usually do not trade anything unless they have an expiration date of every week, and then I trade every week. And the reason why, well, a couple reasons. Number one, I don't want to tie up my capital for a long period of time. I'm a very like quick person. You might tell by my demeanor. Yeah, I just want I want to make money for myself every single week, right? And I don't want to ever give that back to the market. I want to make money, lock it in, and spend it, and move on next week. So me personally, I only look at 1 week expiration. So that's what we're going to look at now when we walk through a trade. And I'm going to choose a strike price of $26. So let me just hop right in. This is my trading platform. So if you have Thinkorswim, yours might look a little different, because a lot of these pieces that you see on the screen, like this chart right here, you can configure different things. You can make it look a little bit different. This is the way I like it to look. So this is kind of like a 1 year chart. I'm always looking at, like, first when I'm evaluating a stock to trade, I'm always going to look, okay, well, where's it been this past year, right? So we see it kind of went up, it went down, it went up, it kind of stayed sideways a little bit, etc. If I click on the trade tab, this is going to show me sort of all my options, my options chain, it's called, right? So here's my dates over here. So October 24th is tomorrow, right? Next Friday would be October 31st. The following Friday is October 7th, etc. So you can see, like, you can do it every single week. Now, as time goes on, you'll see we don't see any weekly ones over here, because you have to wait a little bit of time for those to be opened up, because nobody's trading them yet. So if you don't see something over here, that means it's not traded. And if you do see it, that means that's an option for you a choice for you to trade. So the example that I want to use as we get started is, because today is Thursday, tomorrow's Friday. We could look at one for tomorrow, and sometimes I trade contracts for the same day as well. But we're going to look at a contract for next Friday, which would be October 31st, right? So down the middle, you're going to see strikes. So what's the strike price? So these are just, there's only a handful of a couple definitions that you're going to learn as we go. The strike price is just basically how much are you willing to buy the stock if it drops below that price, right? So let's take a look at ETH as an example. ETH right now, we see the price of the stock right here, $29.19. So right now the market's closed, but other people are trading. So when the US goes to sleep, or the US market is closed, other countries are trading. So if I look at, let's see, if I change this 1 year chart to a 1 day chart, here's kind of like this gray area is where ETH is trading now. But it last traded at $29.19 per share, right? So when we look at the strike prices down the middle, this is the price at which we want to buy, or okay buying those shares, but only if it drops below that price, right? So let's go through a couple of examples. So because ETH right now is trading at $29.19, you can choose, let's say, a $29 strike price, $28.50 strike price, $28 strike price, you know, etc. 27.50. So the strike price when you sell a put is always going to be lower than where the stock is trading, right? So the stock right now is trading at $29.19. So you're always going to choose a strike price that's lower. Now we might say, Michelle, okay, well, how do I choose what number? Like, how do I choose 28, 27.50, 27? Okay, here's the best way to understand that. The further you go away from where the stock is, right? So the stock right now is at $29.19. The lower you go, the less likely you're going to have to buy those shares. Because it's less likely, the lower you go, the less money you're also going to get. So let's kind of like compare that, right? And a lot of these things are very logical. They might be confusing at the beginning. And then once you kind of get the hang of it, it's like, okay, of course, that makes sense. Like, of course, if it's not that likely to go down that low, I'm not going to make as much money, right? So for example, let's say we choose a $26 strike price. What that means is this, and let's look at this line. So the puts are on the right-hand side and the strikes are down the middle, like I said. And here's we're not going to talk about bid or ask or confusing things. This is a crash course. So I want to give you guys like the meat and potatoes of the stuff to say, oh my gosh, this sounds so amazing and so easy. Like I can totally see myself doing that. So I want to give you all that information. So for example, a $26 put that that last traded today, the last trade was 33. It says 0.33. Now, all option contracts always represent 100 shares. It's just the way it is, right? So if I sell one put, that means I'm selling one put and I'm committing to buy 100 shares of that stock, but only if it drops below the strike price. So here's what that means, guys. Let's say ETHA is 29.19 now. It goes down to 28. Maybe it goes back up to 30. You know, what did I say a moment ago? Stocks go like this. All stocks go up and down, right? However, if and when the stock price goes below $26, if I sell a $26 put, that means I'm ready to commit to buy those 100 shares, right? Now, this last traded at 0.33, and because it represents 100 shares, that means I'm paid times 100. 0.33 times 100 is $33. So this particular contract, I would get $33 dropped into my account right then and there. Again, there's no waiting and seeing where something goes up. It's like insurance. So this girl, Jane Doe, is insuring her ETHA stock. She's paying you, right? There's another person on the other side of this transaction, and you keep that money no matter what happens. So 33 bucks gets dropped into your account, and what you're promising is to buy her 100 shares if the price crashes below $26 before the expiration date. In this example, we're going to use next Friday, October 31st, right? Now, if I want to give you guys a little bit extra information, and it's not confusing, but I do look at what's called the delta. The delta is like the statistical likelihood it's going to go there, right? So it's very, very kind of unlikely. So it's approximately a 16% likelihood that ETHA is going to go from 29 bucks, where it is now, all the way down to 26 before Friday. It could happen. So those aren't like, you know, black and white kind of things, but it just gives you an idea of how likely is it to happen. Now, if let's say, if I sold a put that's a little bit closer to where the stock is trading, like let's say instead of $26, I want to sell a $27.50 put, right? Now I'm going to get paid a little bit more for that because it's a little bit closer to where it's trading, right? So that contract is selling for $61. So I'm going to get paid almost twice as much. And it's a little bit more likely. You see 0.28. So it's about a 28% likelihood it's going to go down to 27.50. So the closer that we get to the number where it's trading, the more money we make, because the more likely it is to go there. Does that make sense for everybody? And what we're going to do is we're going to walk through, well, what does that look like? How does that work if I sell a put? Let me flip back through my slide here. What it means, I'm selling a put. In this example, I'm going to flip back and forth a couple times. So I'm going to use this $26 contract and I'm getting paid $33, right? So in this scenario, I'm paid a premium of $33. Now we have to put something up to make the trade, right? And we call that capital. Like, how much money do we have to have in our account to make that particular trade? And when we think about selling a put, the way we calculate how much money we have to put up, if I'm selling a $26 put, what I'm doing is I'm saying I'm going to buy 100 shares, but only if it drops below $26, right? So if I had to do that, I would buy 100 shares at $26. That means I would have to put up $2,600 in capital. Does everybody see that? To make the trade. Now that's if you don't use margin. So we're not talking about margin yet. I'll give you a preview on what margin means. Margin just means like you can use some money from the bank. You don't have to use all your money, right? You can use some bank money. I want to talk about that in a little bit, but when you're new, it's a little bit like more conservative and a little bit less risky if you don't use margin and you just have enough money to make that trade, right? So you have to have 2,600 bucks in your account. Now, what's the worst case that can happen? Okay, if I make this trade and they go bankrupt, let's say, or out of business or something like that, how much could you lose? You could lose 2,600, but you have to kind of evaluate how likely is that to happen. That's why you want to only trade stocks that you believe in, that you feel confident with, that you like for the long term, that you think would go up over the long term, right? Okay, so you have to have 2,600 to make the trade. You get paid 33 bucks. You are committing to buy 100 shares of ETHA, but only if it goes below $26. Now, I want to kind of walk through a couple of scenarios with you. Now, I want you guys to recognize that this contract expires on October 31st. So the time frame that we're looking at for this contract is before October 31st. Whatever happens after October 31st, it doesn't matter, right? So that's the expiration date of the contract. It's over as of that particular date. Now, what could happen is, let's say ETHA goes down to $25, right? That person who owns that contract, I sold Jane Doe that contract because she wants to, insure her stock in case it crashes. She doesn't want to lose all her money. It's up to that particular person to assign it. Now that might sound confusing, but I want to talk through this a little bit in a couple different ways. Usually, it only is, you only look at when the contract expires. So in other words, on October 31st, when the stock market closes at 4 o'clock Eastern time, if ETHA is, let's say, $25.90, that means it closed under $26. I am going to buy automatically, by the way, there's nothing that you have to do on your end. It will automatically happen. I am going to buy 100 shares. But sometimes, let's say it goes down to $22 and then it pops back up, right? What did we say before? Stocks go like this. They go up and down. If it goes down to 22 and that person doesn't assign the contract, and then it pops back up to like $27 or $28, I'm not buying the shares. So I have a distinct advantage, like really kind of like it has to close below $26. A lot of times it goes down, then it goes back up. It doesn't matter. I mean, I'm okay buying the shares. If I have a preference, I don't want to buy the shares. I want to just keep my money in cash all the time, right? But I'm okay to buy the shares if it goes lower than $26. Does that make sense for everybody? Either way, now this is super important. Either way, you keep the premium. So if it goes lower than $26 and it closes at, let's say, $25, right? You're buying 100 shares at $26, but you don't give the $33 back. Anytime you sell an option, and this is going to be true with calls as well, anytime you sell a put or sell a call, you keep that money, right? So that's important. It's kind of like here's how you can think of that. It's kind of like I have car insurance, right? And my car insurance policy comes up, like it renews every 6 months, right? So it goes now for 6 months and then it renews and I pay again, et cetera. And I'm paying a premium to the car insurance company. Why? Because if I smash my car, I don't want to lose all my money, right? I want to shift that risk over to the insurance company. Now, what happens if I don't smash my car? Does the insurance company give me any money back? What do you guys think? No, of course they don't give you any money back. No, they don't. So this is the same thing. You keep the premium no matter what happens. Yeah. Let's calculate now. Before I make a trade, I always calculate, is that a good trade or not a good trade? How can you tell if it's a good trade or not? You calculate the rate of return. Very, very easy to do. I'm going to pull up a calculator. You guys can all see my screen here. And all I'm going to do is calculate the $33 that I'm getting paid for the put, right? And then I'm dividing that by how much money I have to put up. 2,600, right? Because I was selling a $26 put. I'm committing to buy 100 shares at $26 if the price drops below 26. So I'm putting up 2,600 in capital. My rate of return is about 1.2%. That's my rate of return on my money. But remember, guys, that's for 1 week. So what does that mean? That means, like, if you did a trade like this every single week, how much money would you make? Well, how many weeks are in a year? There's 52, right? 52 weeks in a year. I'm making 66% on my money. I mean, who thinks that's good? And raise of hands. Is that good? Like, who's got their cash right now in money market? And maybe you're getting four. Somebody told me recently he's getting 4% and he thought it was a great rate. 4%. I remember when money market rates were like 0.04 or something like that, right? Super low. Who works with a financial advisor here or has worked with a financial advisor in the past? And they spew this nonsense like, okay, the average return on the stock market every year is like 8%, or I think that's the average, like over the long term, 8%. And if they did like 10% or 12%, oh my gosh, they're amazing, right? No, you can make 66%. I mean, 66% of your money. I do lots of videos on YouTube where you can flip your money 100%, 200%. Listen, you are only limited by your own limiting beliefs. And when people say that's too good to be true, you cannot make 100%, it's not sustainable. That's like just get that noise out of your head. That is totally not true. I'm living proof. I can show you exactly now. Now, here's the thing that's valid. Like, let's say stocks go down. Like me personally, I trade a lot of like MicroStrategy, Tesla. It's gone down the past couple of months. That means that my income went down a little bit, or actually it went down a pretty good chunk the last couple of months, but I'm not losing any money. And we're going to get to that as we go more in the presentation here. But what I'm saying is this: the worst case scenario, you don't make as much. But here's an example. If you do a trade like this every single week, you're making 66% of your money. What does that mean? That means if I start with 10,000 bucks, I'm going to make 6,600 just in income alone. And I don't have to wait a year for it. I'm making money every single week. So you want to calculate the rate of return before you put the trade in. I'm going to give you an example. I didn't put this in the presentation, but I just thought of it as I'm going. Let me go to SPY for a moment. There are so many. SPY is like the S&P 500 index, right? It's got like a whole bunch of stocks in there. Last I checked, it was like had trillions of dollars in assets in this particular ETF. And there's so many people on YouTube sometimes that say, oh my gosh, that's so safe. And no, it's not safe. And let me give you an example. And this is related to kind of like calculating rates of return. SPY is $671 per share. Oh my gosh. So first of all, right off the bat, it's super expensive. What does that tell you? That means that you're committing a lot of money, right? $671 per share. If you sell one contract, you're committing $60,000 on one trade. So right off the bat, before we even do any math on a calculator, that's a lot of money. As an example, I'm going to sell a $657 put. There's a 19% chance it's going to go down. Oh my gosh, I'm going to make 200 bucks. You might think that that's good, right? Here's why you want to calculate the rate of return. $201 that I would make, and I would put up in this example $65,700. That's a lot of money. 65.7 on one trade. I'm making 0.003 for 1 week, because this is also on October 31st. If I annualize that out, I'm making 15% on my money. But what I'm doing is I'm illustrating, you don't want to just look at the dollars that you make. Oh my gosh, I'm going to make $200 on this. You want to look at how much am I going to make? How much do I have to put up, right? And then what's my rate of return? What's my percentage rate of return? And then you always want to annualize that out, right? So if you're looking at a trade, let's get out of this nonsense SPY and let's go back to ETHA for a moment. And let's say I don't want to look at a 1 week. I want to look at a 2 week, right? So let's say I want to look at November 7th and I want to look at the same $26, right? $26 put. That last traded at 65 bucks. Now, the reason why it's more expensive is because it's longer, right? So it's 2 weeks instead of 1 week. So the longer we go out, the more money we make, right? But again, you want to calculate, is that a good deal based on the percentage? So let's do that as an example. $65 divided by 2,600 that we have to put up. Now this is 2.5%, 0.025, but it's for 2 weeks, not 1 week. So I'm going to multiply this times 26, right? So you want to annualize it out. So that gives us our annualized rate of return, 65%. I think the other one was 66%. So again, and also like I was telling a guy that I'm working with recently, and this was actually very helpful for him. As you go through your trading journey, I want you guys to know that there's no right or wrong. Listen, I'm here to tell you not that my way is right. I'm just sharing like, here's what I'm doing and it works pretty good for me. But as you go, you're going to like find your groove. Like maybe weekly is not right for you, maybe 2 weeks. Maybe you want to look at a 1 month contract. That doesn't make it wrong. Like there's no right or wrong. There's lots of ways that you can make money. You're going to find your groove. But the most important thing is pick a stock that you like. And you want to also pick a price that you're okay with, right? So let's go back to this October 31st, which was the other example that we were using. The first example that we were using, that's a $26 put. You might say, you know what, Michelle, I have kind of a small account. And I like ETHA, but I kind of really don't want to buy it. I just want to make a little bit of cash and I want to get my feet wet. Maybe you want to be super conservative and you want to do a $24 put, right? Next week, 1 week, October 31st, $24 put. It last traded at $16, right? Let's calculate that. Let's see if that's a good deal. So I'm going to make $16 and I was going to commit 2,400, right? Because it's a $24 put. So now I'm making 0.006. This is for 1 week. So I want to annualize that out. I want to multiply it by 52, right? So I'm still making 34% on my money. So here's what this means, guys. Like you're going to find your groove. Like how interested am I to buy the shares? Do I want to maximize my income? Do I have a little bit more of money in an account? Am I okay taking a little bit more risk? There's no right or wrong, right? So one question, what day of the week is the last day that you can put in a trade to sell a put? So that's a good question, Valerie. You could sell a put anytime the market's open, you can sell a contract. So the US market has to be open. You can't trade an options contract on the overnight market. And you can do a put at, let's say you could sell a put at 3:50 p.m. tomorrow with a tomorrow expiration date. The problem with that or the challenge or what you'd notice is you're not going to get paid very much money, right? So the shorter the time frame, the less money that you're going to make. Let's use our example here. Like I'm selling my $26 put and then it expires on Friday, the 31st of October, and I'm paid $33. Now, what that means is this, and I want to be super clear. As soon as the price goes below $26, you could be assigned, meaning that you could be required to buy 100 shares of that stock at $26. Now, that said, usually in reality, I would say like 99% of the time, it's only assigned when the contract expires. So what that means is usually it could go down and it could pop back up. And as long as it closes on October 31st above $26, if you haven't already been assigned, you will not have to buy those shares. So it's up to the actual person that is on the other side of that contract. I know it sounds kind of weird, but like, okay, my name's Michelle Kinney and I sell a put and there's market makers that kind of match up the buyers and the sellers. They're kind of like people behind the scenes, right? That match the players up. And there's a person on the other side of that one contract. It might be like John Doe in, I don't know, Wichita, Kansas, or Jane Smith in Kansas City, Missouri, wherever, it doesn't matter. So it's up to that particular person. Now, because I gave you the example of, insurance, because that's the easiest way to understand how puts work. But most people are not buying puts as a way to insure their stock. Most people in the market today are buying puts and calls because they're gamblers. So most of the time, I would say, like the majority of the time, somebody is saying, "Oh my gosh, I think Ethereum is going to go down in price, and I want to like 10x my money. I don't want to short the stock, let's say, but I want to make money if it goes down. So I'm going to buy a put for $33. And if I'm right and it goes down a lot, over the next couple of days, I can turn my $33 into $330. So because those people are usually on the other side of the trade, they're not going to assign it. So they're going to wait until the end, and which is the reason. So that might be a little bit more information that we're looking for, but hopefully that answers your questions. I would say 9 times out of 10, it's only going to get assigned when it expires. Also, you want to be made aware of that it's automatically going to happen. So like, let's say again, this $26 put, it's for October 31st, and ETHA closes at $25.50 next Friday, right? Those shares are automatically going to show up in my brokerage account. So it's not something that I have to do. I didn't talk about this yet, but I'm going to talk about it now. You do have the ability to buy back your trade anytime you want. So when you sell puts and also when you sell calls, when you sell options in general, it's not like you're stuck in stone. You can buy your contract back and take the risk off the table. So I'm not going to go a lot into detail because that's more like how do you manage the trade, because we're only here for 2 hours. Like I said, it takes about maybe 6 hours to learn something, and then a little bit practice as you go. But it is important to know, like, you're not obligated to stay in that trade. You can buy your contract back, which might be more or less than what you originally got paid. But you can do that at any time, and you can do that at any time before the contract expires, right? I don't look at any. Somebody asked about technical analysis. Here's the thing, guys, and I truly, I truly mean this. I think people just don't like they don't anticipate this. Two easy strategies: selling a put, selling a covered call. That is it. I trade to live. I don't be looking at indicators or putting things in and looking at screens and all that stuff. I don't want to do all that. I want to, like, I don't know, I want to like bring the dog to the dark dog park, or go swim in the pool, or go to the beach, or go on vacation, or do different things. So no, I don't use indicators. And I also don't really care about the price of something. I trade the same stocks. I just trade the same tickers over and over and over again. So I don't really concern myself with the price and, hey, I think it's going to go up short term, or hey, I think it's going to go down short term. All I'm doing is I'm just like selling puts, selling covered calls, selling puts, selling covered calls on the same ones over and over again. I pay attention to how much cash am I putting in my pocket, right? What are my realized gains from week to week? That's the most important thing. I mean, I put trades in when it's convenient for my lifestyle. So let's say if I'm doing something on a Monday, then I don't put a trade in. I typically like Mondays the best because I had let's say some shares of stock, let's say, and I had some calls that expired worthless, or I had some puts that got assigned, or whatever the case might be. So I particularly like Mondays and Fridays, but I don't necessarily do Mondays or Fridays. I do whatever fits with my lifestyle. This is actually a good question. Do orders ever not go through by not having a buyer or a seller? That's a good question. So let's go back to ETHA as an example. So we were looking at October 31st as an example, and I think we looked at a $26 put. Here's what that means. But whatever the bid is, that means that there's automatically buyers lining up to pay that price, right? So for example, let's say if I wanted to sell this $26 put on Ether. I was giving an example that it closed at $33, which it did on Thursday. But if I put the order in to sell it at $27, there's already somebody there that's going to buy it at $27. So sometimes what happens, without getting too detailed, there's market makers. So if there's not necessarily a person that's going to buy that contract, there's market makers that step in to fill that trade. So there's always going to be somebody that's going to buy that. If I'm looking to sell it at the bid price, there's always going to be somebody that would buy that at that particular price. The moral of the story is, where we left off when we were looking at the slides, is you always want to calculate the rate of return. And you'll see by the calculation that we just did, even like super conservative trades where we're committing to buy the stock if it goes super, super low and we're not making that much money, we can still make, 33, I think that was 33% on our money, right? The worst case scenario, so going back to selling a put now, before we move on to selling a call or a covered call, the worst case scenario when you sell a put is that you buy the stock on sale. And I think this is super important. I want you guys to understand that, because oftentimes there will be people out in the marketplace. Oh my gosh, like trading options is risky. I know somebody, my neighbor, lost all their money doing that. You want to understand what the risk is and identify it and kind of, realize or think through, is that a risk that I think is important? Is that a risk that I would live it with? When you sell a put, the worst case scenario, let's say in my Ether example, let's say I sold this $26 put, right? And Ether drops down to $20, right? Now I'm committing to buy my shares at $26. So the worst case scenario is I'm going to buy a stock that I like on sale, because it certainly would be lower than where it's trading at now, right? Ether's 29 bucks, right? And I'm selling a $26 put. But if I buy it at 26 and now it's at 20, I'm going to have a short time frame where I might have a paper loss. I don't care about paper losses. Listen, stocks go up and go down like this. And before anybody says, well, what if, I don't want to buy stock at $26 if it's at 20 bucks. That's going to happen sometimes. Now you could roll your contract into the next week. I have lots of videos actually on YouTube that talk about that. I never do that. So whatever strike price you choose that you're going to sell a contract at, you want to be prepared to buy those shares at that price. Now you could buy your contract back and take the risk off the table. It might be more or less than what you originally received in premium, but you don't ever want to roll your contracts. So maybe just like jot that down. If you guys are taking notes, or take your phone out and just write, do not roll your contract. Don't ever do that. That's the dumbest thing that anybody can ever do. So many people do that, so many retail traders, and I'm telling you, it's like the stupidest thing that you could do. So don't do that. If, let's say, Ether goes down to $20 and I buy it at 26, you know what I'm going to do? I'm going to buy more. If it goes down to 20, I'm going to sell a $19 put, and I'm going to buy more as it goes down, because I'm going to average my price. Now, when I talk about these things, you want to make sure that you're trading something that's consistent with your account size, right? So for example, we showed this Ether trade having needing $2,600 to trade, right? But really, you don't want to, let's say if you only have $2,600 in your account, you probably want to choose a stock that's a little bit cheaper, less expensive than Ether, because you don't want to like sell a put and then have to buy the stock. And if it goes down, you don't have any more money to let's say sell another put or buy more shares. I try to always have cash so I can put more money in if it goes down low, because that way you're not just like waiting around for it to go back up again. Does that make sense? A little bit more advanced. But you want to trade tickers that are like consistent with the size of your account. So let's say you have a $10,000 account, and if the stock is 29 bucks, 30 bucks, you might look at a stock that's a little bit cheaper. Maybe look at a $20 stock or something like that. And there's lots of them. Listen, there's lots of great stocks for small dollar values. I was looking at this one stock recently, BBAI, Big Bear. It's a $6 stock. It's an AI company. AI is great. BBAI just got this like big contract with the Department of Defense, I think, which is interestingly not even called the Department of Defense anymore, I think. But I don't want to get into politics. But this is a $6 stock. So what does that mean? I can, let's see, that's October 24th. So that's tomorrow. So we won't look at that. So let's look at like an October 31st. Let's say if I have a smaller account, I can use a cheaper stock. That's what you want to do. I can sell, let's say, a $6.50 put. Now I'm only putting up $650. And now if it goes down a lot, I can buy more after it goes down and average my price down. Does that make sense? How many contracts should you trade? Listen, guys, just start with one. I was working with someone recently, and he had a good chunk of money, but he had way too many contracts and way too many tickers. 10 of this, 15 of this, 5 of this. Just start with one. Baby steps, learn to walk. And the reason why you want to start with one, even if you think you have a lot of money, is because of this. If it goes down in price, you want to keep some cash. You don't want to tie up all your cash on one trade. You want to keep some because in this scenario, my ETHA, as an example, I have a $26 put. And if the price goes down to $20, I want to have cash so I can sell a $20 put or a $19 put or something like that. So just do one contract. That's it. No more. Do you have a process on how to pick stocks? So that's a good question. When you choose a stock, it's just choose one stock. When you're starting to trade, just choose one thing, right? You don't have to make things complicated, and choose something that you think that maybe you resonate with. When I was trading a long time ago, I would trade things that, like, let's say if you're familiar with Apple, you have an iPhone, that kind of thing, maybe Apple's a good stock. I mean, nowadays their volatility is a little bit low. You don't make that much money and it's kind of more expensive. But I'm saying choose something that maybe you might be familiar with, that you resonate with. Choose a stock that you're okay buying and holding. If you had to buy those shares, that you're okay holding for the long term, right? Try not to. I mean, when you have some experience, it's okay to, like, let's say, do some gambling. You might say, like, GameStop. I did a video the other day on Donut, Krispy Kreme. It's kind of like this meme stock, right? But try to stay away from those kind of things, especially when you're new. So just do something solid, that you think is going to be around a long time and that goes up over the long term. All right, so let's go back to our presentation. After you buy the stock, if and when you have to buy the stock, like let's say we're talking about puts, right? And let's say I sell a $26 put and the stock goes down and I have to buy 100 shares at $26. Don't freak out. Don't like think it's the end of the world. Don't go jumping off the bridge or anything. That just means you buy the stock and now you could sell a covered call against your shares. This is called the wheel, guys. So like you sell a put, the price goes down, you buy the shares, now you sell a call against it. It's okay. The way you want to trade is you want to, like, structure things in which you can make money whether the stock goes up, whether the stock goes down, or whether it stays sideways. I mean, I care a little bit if my stuff goes down, because if it goes down a lot, like Bitcoin, MicroStrategy has gone down a lot. So my income that I make on a weekly basis has gone down a bit because of that, because as the price comes down, the price for calls are not going that much. You know what I mean? So it's a little bit relevant, but in a sense that your income goes down, but you don't ever lose money unless you sell your shares for less than what you paid, and you just don't want to do that. So if and when you get assigned the stock, don't freak out. You're going to sell a covered call against that. And let's talk about what that means, because I know that there's some people on this call that have done a couple of trades and that sort of thing. And then there's some people that are super new and maybe you don't know what a call is. So let's talk about what a call is. This is the easiest way to understand what a call is. It's like renting your house out on Airbnb. So let's say I have a rental property, a place on the beach, and I rent it out on Airbnb. The guest pays me money, right, to rent it for the week, right, or 2 weeks or whatever that time frame is, right? They pay me money to rent it, and if they want, after their stay is over, they could buy my house. at a predetermined price. This is the same thing as selling a covered call, right? A covered call is the same thing. We're going to go through exactly the Ether trade that we went through, just so you can kind of see like apples and apples and how that might work. And let's say we sell this $26 put, and then Ether goes down, and then we buy the shares. What do? We sell a covered call against those shares. Now, sometimes people might say, well, what does that mean, covered? Covered just means you have the shares. So you're only going to sell a call if you have the shares of stock, right? I'm going to say that again. And this is important. When you sell a put, you don't need shares of anything. You just need cash, okay? You don't need shares of anything. But when you sell a call, you want to have those shares because that's what makes it covered, right? I don't want to trade strategies that I might get lucky sometimes and then I might lose all my money afterward. I want to do things that are very easy to replicate on a regular basis to create a systematic stream of income. So don't sell. That said, my point is don't sell naked calls. If you sell a call, you want to have the shares. Does that make sense to everybody? When you sell a put, you don't have shares of anything. You just have cash. And when you sell a covered call or when you sell a call, you're always going to already have the shares. So let's go back to my example. I sell a put on Ether, a $26 put. The price goes down and I have to buy those. Now I have 100 shares. Now that I have the shares, I'm going to sell a covered call against those shares. So let's kind of walk through that and see what that looks like and what that means. Again, it's going to be the same as a put, just a little bit different concept. So you're going to have the stock is going to be Ether that we're talking about. You're going to choose the expiration date, right? And you're going to choose the strike price, right? So for the expiration date, that's easy. I only look at 1 week. I encourage you to just do what I do, especially at the beginning. I mean, I'm saying you're going to find your groove and what works for me. Like you might find something different, but the easiest way to be successful is just to find somebody else that's successful and just do what they're doing. So I would encourage you just to look at 1 week, right? And when you choose a strike price for the covered call, you always want to choose a price higher than where you bought the shares from. So let's look at the Ether example as an example. So here was our Ether October 31. This was our $26 put, right? So if you have to buy the shares at $26, I'm gonna actually say something else too that I think that's helpful. So let's say Friday comes and I have to buy these shares. 100 shares show up in my account, right? And then I see the cost basis of my shares will say $26. Cost basis is kind of like, well, how much did you buy the shares for? It'll say $26. Now, depending on your brokerage, it might be different depending on who you trade through. Schwab, for example, and Thinkorswim, for example, Monday, it'll say $26 is your cost basis. But on Tuesday, it will get adjusted to to net out the price of the premium that you got paid for the put. Here's what that means. And if this is confusing, you don't even really have to know it. It's just a little bit more advanced. And there's a couple advanced people here. So I want to deliver value to everybody. But if you buy the shares at $26, and you originally got paid $33 for the 100 shares for the put, your cost basis on Tuesday with Schwab is going to show $25.67, right? So just don't be confused by that. I don't want to get too much in the weeds, but I do want to make this point. If you buy the shares for $26, you want to use $26 also when you sell your covered call. Now you could use a different price if you want. You could use $26.50 or you could use $27 or $27.50 or whatever. You don't want to use lower than 26. Why? Because you paid 26 for the shares. You don't want to commit to sell them at a lower price. You never want to sell your shares for less than what you paid, right? Because that's the only way you lose money when you trade. You sell your shares for less than what you paid. Just don't do that. The reason I use the same price, the $26, is a $26 call. I'll give you an example. Well, let's look at a Ether right now is $29. So we're not going to look at a $26 call, but we're going to look at like a $30 call or a $31 call, right? A $30 call is last traded at 91 dollars, 91 cents, but times 100, you get $91 in premium. Whereas a $31 call last traded at $58, right? So the closer you are to where it's trading, the more money you're going to get. My intention on selling options is I want to create as much income as possible with the money I have invested. I don't want to, I don't ever get in a position where, oh my gosh, I love Ether. I love Ethereum. I want to keep that shit for forever. No, I don't care about the stock. The stock doesn't make me money. Contracts make me money. Selling options make me money, right? There's so many people out there, and I'm not going to say that they're wrong, because if it works for them, it works. Okay, they're happy, but they're just missing the boat. Like, I mean, unless you want to buy stock and keep it. But I feel like, and does anybody disagree with me? I want to set the tone here. Does anybody think, like, when we talk about stocks, if I own stocks and the stock price goes up and I have that paper gain, that means absolutely nothing. That is so irrelevant to me. I don't care about that. I want to create cash in my pocket. So if anybody's here on this call and they like, oh, I love this stock and I want to have this stock because I think it's going to go up, I mean, that's cool, but that's not what I'm doing. So I might not be the person for you if that's what you're looking for. What I do is I want to create income on a regular basis, and I use that stock. It's kind of like having a house. Let's say I own 10 houses and I can't be in them all the time, and I rent them out. Like, I want to have something that creates income for me on a regular basis. So that's what options do. So my point is this: I don't ever like fall in love with a stock. I just shoot when I sell a covered call. I sell a covered call right where I own it for, or whatever that strike price is higher than that, because I want the shares to get called away. I don't want to keep those. I don't want to keep that stock. I want to make as much money as possible. And then you know what? Next week, I can buy those shares back. And sometimes I pay more for them. So I don't care what the price is. I just want to trade the same tickers over and over again. And I want to create income on a regular basis. This system works. If you're looking to create income on a regular basis, this is how you do it. So somebody said, this is actually good. I sold a call below my basis once. Let's see, let me read it first. And it went in the money before the expiration date. And then I had to roll it afterward. So don't ever do that. So that's a big mistake. So, and that's okay. So I'm not here to say, hey, like, slap your hand, you messed up or whatever. Listen, we all make mistakes. I've been trading since 1997. You know how many times I made mistakes? I made lots of mistakes. But the key is learning, right? So you never want to sell a call for underneath what you own. So what happens is this. I'm going to give you guys an example. Like right now, I have 300 shares of MicroStrategy. That's a lot. And I have shares that I paid a lot more, right? So let's look at MicroStrategy as an example. It's just for learning, right? So look at, this is the last year, right? It goes up, it goes down, it goes up. And then holy cow, like since July, it's been going down, down, down. So the past 3 months, I have a whole bunch of MicroStrategy, right? And what happens when you own shares and the price goes down, the calls aren't worth that much. So sometimes I either sell a call and I don't make that much money, or I don't even sell a call because it's not even worth my time. Like, $10, $50, whatever, is not even worth doing. What I would not do, sometimes you can get incentivized, like, okay, I'm sitting on my hands for a while and let me sell a call for underneath my basis, right? Because I want to make a little bit of money. I would encourage you, don't do that. That's like a can of worms. It's, especially if you're trading things that are volatile, like a lot of these Bitcoin stocks they have a lot of volatility. That means that they go down a lot and they can also go up a lot. So you don't want to sell a call for underneath your basis, because if it gets assigned, or if it's going to get assigned, then you're going to roll it. No, that's just like, that's making one bad decision after another. Just don't do that. Hopefully that helps. How will margin work with options? So that's good. So let me go back to ETHA here for a moment. And I do want to talk about margin. So margin is like borrowing some money from the bank. I use margin. So I'll say that I use margin. And I will say this, and this is important. I want you guys to hear this. If you don't use margin, it is very hard to lose money in like trading, selling a put, selling covered calls. You only lose money when you sell your shares for less than what you paid. It is so conservative. If you have like, I don't know, 100K, you can make like 50K like clockwork, like with very low risk and never, ever, ever lose money, basically. Now, I'm not giving you guarantees because again, your money's your money and there's always going to be risk in the market. But what I'm saying is this, if you're not using margin, it's very very conservative. If you do use margin, which is borrowing some money from the bank, you have to understand how that works. And it's very important to like kind of look ahead of time. Do I have enough money to sustain these positions? The only time that I've ever lost big chunks of money, to give you like serious real talk from me to you, is from using too much leverage and not, I don't want to say not understanding because I always understood it, but not really anticipating a significant move and then not having enough money and having to liquidate my trades. And then you take a realized loss. I am developing, this isn't a commercial, but this is actually really good. I have a tool that I created myself. Like I programmed it using Python and taking like an API feed through Schwab to pull in my positions and then have like a hypothetical tabs like, okay, if MicroStrategy drops 10%, if Tesla drops X%, if Ether drops X%, what does that do to my investable money? Will that create a margin call? I use that on a regular basis, and I'm going to roll that out to the public soon. It's going to take a little while, and it's not available yet. But it's very important to have a tool like that if you use margin, because it's easier to lose money if you use margin. But let me show you how margin would work on my ETHA trade as an example. So we were looking at a ETHA is $29.19 per share. And we were looking at a $26 put, right? That last trade at $33. So first of all, the easiest way to see what the margin requirement is to look on the platform. So the margin on stocks are going to be different depending on the stock and also the broker dealer that you trade through, right? So the way I check is, and I use margin, like I said, is I click on the bid and it pulls up this order entry box. So this is as if I was placing an order. I'm going to sell one ETHA October 31st, $26 put. And then I'm going to right click or command click if you're on a Mac. I'm on a Mac. And then I'm going to analyze the trade. And then it pulls up this this margin box. So I have 600 shares of ETHA now, so ignore the top there, but look at the naked -1 ETHA $26 put. So here's your margin requirement. So the margin requirement, sometimes it might be 30%, sometimes it might be 40%, sometimes it might be 50%, sometimes based on the stock, maybe you don't even get any margin on that particular stock. So this is the easiest way to look at it. So here's what this means, guys. If I'm using margin, I don't even need $2,600 to make this trade. I just need 325 bucks. But the danger with margin, or the precaution, I wouldn't say danger, I would say precaution with margin is this. You don't want to understand it as, okay, all I need is a $325 in an account and I can put this trade in. No, not really, because if the price goes down, your account value is going to change and the margin requirement is going to adjust. And if you don't have enough money backing up your account, then that could create what's called a margin call. And a margin call is just like the broker dealer knocking on the window and saying, hey, you don't have enough money, you got to put some cash in. And they don't always wait for you to put cash in. They can actually just liquidate your trade. So what you want to do when you trade, the biggest focus that you want to pay attention to is realized gains and realized losses. like paper gains and paper losses. Like let's say, as an example, I sell this $26 put on Ether, and the price of Ether goes down, goes down, goes down. That the price of that put is going to go up, right? Because it's going to become more expensive because the price is dropping. Whatever the price is, I don't really care about a paper loss, because as long as I have the money to back up that trade, it doesn't matter. But once if I incur a margin call and I have to liquidate something, and I have to actually recognize a loss, that's what really like messes up your account, and that's what blows up your account, you might say. So if you're trading with margin, you have to have a lot of precaution. It's very easy to make money in the market, but it's harder not to lose it. And margin is one of those things that can cause you to lose money very, very quickly. But that's kind of how margin works. And also, like, let's say if I wanted to buy 100 shares of Ether, the way I would check that margin as well is I would just click on the dollar here, and I would just go buy. I would just click on the buy box, and it pulls up this order entry, buy 100 shares. I'm going to right click that. I'm going to analyze the trade, and then I'm going to go here. And well, I already had 600 shares, so now it's going to show 700 shares. So 700 shares would be a margin requirement of $6,100. So that's like the easiest way. You can calculate it mathematically, but the thing with margin, listen, guys, I am a firm believer that Wall Street like does not want like regular retail investors to be successful. First of all, they tell people options are dangerous, options are this, options are that, and that's not true. And then secondly, they don't actually give people the tools. Like there's no tools with Thinkorswim or other broker dealers, and I've been doing this a really long time, that help you like really identify, where a margin call is going to happen. So that's why I started creating my own. I created my own and I use it myself, and now I'm trying to figure out how I can roll that out to the public. Because that's one way that you can very easily blow up your account. Hopefully that answers your question. So we were talking about Ether, when we kind of shifted off a little bit, and what that means to sell a covered call. So let's just kind of get back on track, because I definitely want you guys and put some questions, some more Q&A in the questions area, because I want you guys to really understand, especially the fundamentals of what does it mean to sell a put, what does it mean to sell a covered call. So just to go back through what it means to sell a covered call, you are paid a premium. You keep that no matter what happens. And what you're doing is you're committing to sell your shares if it goes above a certain price, right? So that's called the strike price, if it goes higher than the strike price. So if it goes higher than a certain price, you are committing to sell your shares at that price. You have your shares up as collateral. So a covered call means you own the shares, right? Already, and you're agreeing to sell your shares if it goes higher than a certain price. If it doesn't go higher than that strike price, you keep your shares. You keep the premium you got paid. You keep your shares. And then guess what? You sell another call next week. Covered calls are like literally like the most conservative things ever. Now, what you don't want to do, and I know we talked a little bit about rolling. I didn't really go into detail that much, but sometimes I'm going to give you an example. Let's go through the example of Ether as an example. Here's Ether, and I did this $26 put, and then I have to buy the shares, and then I sell a covered call against it. Well, let's say I sell a $26 call, because that's what I paid for it, right? And let's say before, a couple days in, before the contract expires, Ether shoots up like a rocket, and it goes to $35. Now, oftentimes, many traders out there will be like, oh my gosh, what the heck did I do? The stock is at $35, but I sold at 26 and I lost all that money. Don't ever say that. That's one of the dumbest things that people will say. First of all, you didn't lose anything. You made money. So selling options is all about taking in little bits of money over and over and over again. You don't lose money if the stock shoots up and you missed that appreciation, but that is one of the things that you want to be aware of. When you sell a covered call, you cannot lose money. You're paid a premium. You keep that no matter what. You sell a covered call with a strike price over what you paid for. So if you have to sell the shares, you're either breaking even on the shares or you're making money on the shares. You're not going to use a strike price lower than what you paid for it, right? So you're not going to lose money. The only thing that you might lose is if it goes up to 35, you could have maybe made that. I would much rather, here's the analogy that I use. I would much rather have like a guaranteed $100 today than like a maybe $120 in a week. I don't ever cry about I could have done this or I could have done that. I'm happy with the money that I make on an ongoing basis. When I first started trading, old school, like we didn't even have computers then. Like in 1997, I used to call the dude up on the phone, and I used to have like the Investors Business Daily newspaper, like looking at the pricing and the data in there. And my broker at the time, like when I first started, he said, Michelle, don't ever get greedy. Pigs get slaughtered in the market, right? So don't ever be in a position. The people that roll, I'm gonna my price goes down and I want to roll that put out, or the price shoots up and I'm going to roll that call. Those are people that are not going to be successful in 1 year, 5 years, 10 years. Don't ever do that. Be happy with making money over and over and over again, and calculate the percentages, the rates. So again, it's not the dollar value. It's not like, okay, I made 33 bucks. Okay, how much money did I put up? Let's see if I use margin. Let's go back to my example. What was that margin requirement? If I sold a put, that margin requirement was $325, right? So let's calculate that now. And let me show you, and this is why I use margin, because I can make a lot more money with a smaller dollar value of capital to put up. I'm making 33 bucks on this put, right? So earlier we calculated 33 bucks and putting up 2,600, but you actually don't need 2,600. Let's say you put up 325 because that's the margin requirement. I'm making $33. I'm putting up $325. I'm making 10%. You guys see that? 10%? How long am I keeping this trade for? 1 week. So what am I going to do? I'm going to multiply by 52 to get my annualized rate of return. I'm making 528% on my money. Does anybody not believe this? Does anybody think that this is full of shit or no? I have to stop swearing. I think that's not nice. Yeah, I mean, you can literally make, 30, 40, 50%, 100%. I'm not here to say, hey man, you're going to like double your money. But what I am here to say is you can make a nice steady stream of income and not lose money on a regular basis over and over and over again for the whole rest of your life. That's what I'm here to say. It's pretty dope. The worst case scenario, I mean, selling a covered call is the safest strategy there is. There's no worst case scenario in selling a covered call. You know why? Because you already have the shares. So you already have the shares. You might have some fluctuation. Like if the share price goes down, you're going to have a paper loss. Paper loss means nothing unless you sell the shares. Don't ever sell the shares for less than what you paid. How can you lose money? You sell shares for less than you paid. Don't do that. The other way you could lose money, the only times ever that I've lost, and I've blown up some accounts before for sure, was taking too much risk, too much leverage, and not having enough capital and using too much margin, which is why now I have my own program that I created, that I programmed, that I coded to avoid that from ever happening again. If you want to know more, just hit me up, but it's not available yet. Margin, I talked about this before. It's borrowing money from the bank. But you're going to lose long term unless you have somebody to help you. And why I put this here is because there's no technology tools that help people do that. If you use margin, or if you're already trading using margin, I encourage you, send me an email after and we could talk more offline about that. I want to see people successful, and I never want to see somebody make some mistakes that I made in my past, like blow up an account or lose chunks of money, that kind of thing. You could also do some paper trading. If you're new, you don't have to just trade real money. You could just open a paper trading account. All broker dealers or most broker dealers have paper trading accounts where you can practice, right? So like before you put your money in, practice and see how the platform goes, selling one contract or buying it back or that sort of thing. Practice as you go. And absolutely don't get stuck on the price. I think I touched on this before. Just pick a stock that you like. It doesn't matter how much it is. I never ever think, oh my gosh, like I don't know, something's happening next week, and I think Bitcoin is going to go down, or I think blah 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 is going to go up. I don't focus on that. I do always pay attention to earnings, so I think that's important. Like for example, I mentioned that Tesla call I sold recently. I got $1,200 because earnings is, I think earnings was yesterday or something, or maybe today. I forget. But a couple days before earnings and a couple days after earnings, you'll have more volatility. So when you have things, I like trading things that have high volatility. How volatility is like how much swing. And you can see the volatility here in the implied volatility. So like ETHA, the implied volatility is typically in the 80s. The higher the implied volatility, the more swing that has. And that does a couple things. Number one, you can make more money. So the more swing it has, typically the higher the premium is, right? Dollar wise and rate of return wise. But also like from a fundamental kind of standpoint, if it's got a lot of volatility, it means it goes up a lot or goes down a lot. So if it goes down and I have to buy the shares, I'm comfortable knowing that it's probably going to pop back up at some point in the near future. Because here's what stocks do. They go like this, and over the long term, especially crypto stocks, they go up, right? So when they have a lot of volatility, it gives me more comfort of not being like afraid that much if I do have to buy the shares, because there's going to be an opportunity for me to sell a covered call against those shares and make money again. Yeah. So here's the mistakes that people make. Here's some common ones. I'm going to put rolling. Actually, rolling is like number one. They roll their contracts. Don't do that. Don't love it. Don't do that. You could do that, but I think that's the dumbest thing ever. That's just my opinion, and it's my experience that it's just don't do that. Most people trade too much. They trade too many tickers, too many contracts. Listen, guys, just do one contract and just stick with one ticker for now. You don't need a whole bunch of things. If you got a bunch of things, it's hard to manage. And when you trade like one thing or just a handful of things, if the price goes down, that it's more of an opportunity for you to have cash to target those tickers to buy more shares to average your cost down. So that's a better strategy. Most people lose money because they don't understand margin. Also, I think people try to predict where something's going to go. So again, I never say like, hey, I think this is going to go up, or, Apple's coming out with the iPhone, I don't know, 19 or whatever, and I think the price is going to go up, or Christmas is coming, so I think the price of this Target is going to go up. I never look at that. I just choose one stock or a handful of stocks that you're comfortable with, and then just trade those over and over again. We talked before about being disappointed about not making enough money. Don't ever look at things like that. Like, just be happy with, I'm going to hit singles over and over and over again. And most importantly, or probably equally as important, if not more so than the other ones, is don't freak out when the stock goes down. So like if you sell a put and you have to buy the shares and it goes down, it's okay. Listen, paper losses mean nothing as long as you have the money to sustain that trade. So again, margin plays a little bit different of a role, but if you're not using margin and you have a paper loss on a stock, it means absolutely nothing. So just recognize that it will go back up. If you're trading a good stock and it has volatility, it will go back up. Next steps, I put together, I'm going to go through the questions and answers as well, but I did put together some next steps that I want you guys to be aware of. I mean, I have this inner circle and it's free anyway. And anytime I have new stuff or whatever, or I have something coming up that I think people would like, I send you an email about it. So if you want to join that, I think that's good. Some next steps, I think it's important to talk about, okay, well, you spent a couple hours with me today, you learned about selling puts, you learned about selling calls. Now what? Like, okay, now what do I do, Michelle? What's the next step? So obviously you could go ahead and do it yourself, obviously. There is, some of you guys have already done this, but I did a course, a live event, I don't know, I think maybe like a month or two ago. And it was like about 6 hours. I think it was 5 days, 6 hours total or something like that. Here's the link. I'll send it to you. And I'll send you a coupon code for that as well. So it's on, it's online and you can go over a little bit more detailed because this was like 2 hours, kind of like highlights all the things. But the actual 6 hour like live event that I did really goes into a lot of detail and some more details that you probably want to know if you're trading and you need some help. I started a Monday program recently. The Monday program, it's like live online. We do screen sharing. A lot of times people say, Michelle, like I'm kind of nervous to put this trade in. Like, can you walk me through it? Or can we talk through, is this a good trade opportunity? Is it not? It's 99 bucks a month. If you join and if you like it, you stay. And if you don't like it, it's pay as you go. So if that's something that's of interest to you, then feel free to join that. Option 4 is do nothing. I hope that nobody's going to do nothing. Like either yeah, look at all the thumbs up, laughing emojis, and hearts. There is nothing worse than, I think, having some amazing opportunity, but then you don't take any action on it. Yeah, so I mean, you could do nothing, but I think, listen, you need like, I don't know, 2,000 bucks to start trading. You could start with less too, if you wanted to. I firmly believe that trading options, particularly selling options, selling puts, selling covered calls, is absolutely life-changing. Listen, I don't have a gig. Like I mean, I guess I had a couple jobs when I was younger, a long, long time ago. But it's a beautiful thing when you work for yourself and you do your own thing. Also, I put this up here. This is cool because there's a handful of people that I've been working with like one-on-one. And man, I feel it makes me feel really good that I can be instrumental in helping people like prepare for retirement or replace their income, that kind of thing. So I'm going to put together this. I had a couple people ask me about this recently. It's going to be in November, 3 days a week, Monday, Wednesday, Friday, 1 hour per day. So there's 12 sessions, only 10 people. Because I want to keep it a small group. It's going to be $6,000. But if you do it, I don't want to say today, I would say before tomorrow, because I think people should also sleep on big decisions. I don't think anybody should ever spend a lot of money like that. And I never want to be a pressy kind of salesperson. That's not me. But this is going to be cool. Like it's good for people that have a little bit of money, like 100,000, couple 100,000. And my goal is to show you, man, like you can absolutely replace your income. I mean, I'm showing you how you can make 50% like this. And oftentimes it's even higher. And I'm going to have a money back guarantee. I never did that before. But if I can't show you exactly how to pay for the 5K that you pay for it, in the first, it's probably going to be way less than 60 days, then you get your money back. Like I'm that confident. So if you're interested, I think it's good for people. And I feel really blessed that I have actually helped people like, create income that they never really looked at or thought about before. Yeah, nobody needs a day jobs are overrated. I truly believe work is overrated. Let me pull up the Q&A and go through some questions. Let's see. If I sell a put and sell a call at the same time. Oh, that's a good point. So let me go through this. What happens to my sell a call if the shares are not assigned? Okay, so let me go through that. Let me use ETHA, like continue ETHA as an example. So let's say I sell a put for tomorrow, and let's say I sold a $31 put, And right now ETH's at 29 bucks, right? Now you cannot sell a covered call until you have the shares, right? You could, if you're using margin, and it's kind of dangerous to do that. So I would say it's like best practices. You would wait. Like if let's say I sold a $31 put on ETHA, and I'm probably going to get assigned, or let's say I sold a $33 put as an example, 33 bucks, and it's way lower, right? I'm probably going to get assigned. I'm not going to sell a call until Monday, right? So first off, right off the bat, you could though, and I do this oftentimes. Sometimes I do puts and calls together, and here's how I do them. Like, let me give you an example on ETHA as an example. And I can look at tomorrow, but I'm going to look at 1 week, because tomorrow you probably won't get that much premium. So right now is 29.19. Let's say, as an example, I have, I don't know, 25,000 bucks in an account, and I never even traded anything yet, and I'm not sure what I want to do. I could do this. I could buy 100 shares of ETHA at 29.19, and then I would sell a 29.50 call that like just right over what I paid for it. So if I paid 29.19, 29.50 is the next strike over what I paid. That's how I always do it. Because I don't want to keep the shares. I want to make as much premium as possible. This last traded at $109, right? So I might do that. And at the same time, I might sell like a $25 put. So I'm going to buy shares at 29 bucks. I'm going to sell a covered call against it, and I'm going to sell a put at the same time. So I often have, long shares, short covered call, and short put. But if you only have a short put and you think you're going to get assigned, you don't want to sell a covered call until Monday, until you see the shares in your account. Hopefully that answers your question. Do I use an Excel sheet? Yes. So, Luis, that was a really good question. I keep track of so many things in Excel. If you guys have like tracked my stuff for a while, I've given out spreadsheets a lot, but I tend to change them often. So to give you a little context behind this, the past couple years I was paying like programming people, because I had these ideas. Hey, I want to do this. I want to, I can't find this in the marketplace, and I want to keep track of this. I want to make this easier to manage, right? So I was paying programmers, and they sucked, and I spent a lot of money. And I would say like 6 months ago, I said, you know what? ChatGPT is like my best friend, and I'm smart anyway, and I'm going to just learn some Python. I'm going to code it myself. So I've been coding a lot of things. I've been using them myself, but they're not really ready for other people, because the API has to be different when it's like public facing. But right now what I'm doing is I use just a regular spreadsheet where I keep track of weekly premium, right? And then I also kind of like just add it up, like how much did I make in January? How much did I make in February? How much did I make in March? But I keep track of realized gains only. So somebody asked, you take earnings into account before placing a trade? I think I talked about this a few moments ago. Yes, I do. So typically when you're new, you might want to stay away from placing a trade like right before or right after earnings, because you have a little bit more volatility. I think it's best when you're new, like just be super conservative, because the last thing that you want to happen when you're new is like take a little, maybe too much risk, and then lose money and you didn't anticipate it, or something goes sideways, and then you throw up your hands and say, oh my gosh, this is too hard for me. I think if you set yourself up, the best way to set yourself up for success is to really like just trade something small, like very inexpensive, super far out of the money, like actually BBAI as an example. I don't know, that's a good example. It's a $6 stock, right? So let's see a $6, it's right now $6.78. You can sell a $6 put that expires next Friday for $13. It's not that much money, but like if you do something like super low cost and low risk, it's kind of far away from where it is, it's not going to hurt you that bad. Let's calculate the rate of return on this real quick, because I'm curious. So it last traded at $13, and I would be putting up 600 bucks because it's $6 per share. So that's 2%. So it's only $13, but from a percentage standpoint, right? It's 2% for 1 week. It's a pretty good 112% on your money. And the reason for that is the volatility is super high. Look at the volatility on that. It's 135%. I mean, they might have earnings, but that stock is highly volatile anyway. But yeah, just stick with something kind of inexpensive, one contract, don't do multiple contracts, far away from the money and get your feet wet. So somebody says, I don't understand short and long. Okay, so that's a good question. So those certain things are used like synonymously, like together. Like if I sell a put on BBAI as an example, I'm short a put. If I sell a put, I'm short a put. If I own the shares, let's say I have 100 shares of BBAI, you can also say I'm long those shares. So that's kind of like how those terms play in. Do you recommend any website or newsletter that shares good info on the option tickers on a weekly basis? No, I never use any of that kind of stuff. I mean, I plan on maybe creating some of that stuff moving forward. But yeah, I don't use a lot of, I don't use a lot of stuff. I trade like a handful of tickers over and over again. I like Tesla, I like MicroStrategy. I've been trading Ether, I got a bunch of Coinbase. That's kind of, and sometimes I've traded some things on and off, here and there. Right now I have a lot of MicroStrategy, Coinbase, and Tesla because the prices come down. So I'm not really trading other stuff. And I don't look at a lot of other like content. I think here's the thing about trading. I think that sometimes us as humans, like we can make things kind of difficult. And be looking at like, I don't know, they call it like a squirrel syndrome, right? Like look over here, look over here, look over here. I think it can be as easy as you make it, or as it could be as hard as you make it. I don't think it necessarily has to be hard. I think you just stick with one good ticker, a handful of good tickers, 2, 3 good tickers, and you just trade them over and over and over again. This will become boring. If you're doing it right, it will become boring, and you're only going to spend like 15 minutes a day on it. Do you look at the delta when you sell a call or a put? So I primarily only look at delta, and delta is going to tell you, what's the statistical likelihood that the stock is going to go from where it is now to the strike price. Like going back to Ether or whatever stock. I look at the delta and I look at the implied volatility. For a call, when I sell a covered call, I don't really look at the delta. I just sell it right over what I paid for it. The only exception to that is let's say Friday happens. Let's say, as an example, Friday happens and I have this $26 put and I end up buying 100 shares of Ether on Friday. Let's say Monday, something happened over the weekend and Monday opens and the stock is $30, right? In that scenario, I would sell a $30 call, generally. So the only time, other than that, I would just sell a $26 call. So I don't really look at delta for that. Somebody asked about how taxes work. Let me answer that. So if you can trade options in a taxable account, or you can also trade options in a retirement account, right? So if you're trading in a taxable account, like a regular individual account or a joint account, you are gonna pay, or you are gonna be subjected to short-term capital gains. So short-term and I'm not a tax expert, so I'm not giving you tax advice, and I don't even do my own taxes. I have somebody else do them for me. But short-term capital gains is going to be at your ordinary income tax bracket, which is not as advantageous as, let's say, long-term capital gains. So you do pay a bit of taxes. Sometimes people say that they don't trade options because of that. I think that's like an ignorant statement to not do it because of that. Like as long as you're making money, you're going to pay taxes. But that said, I will give you kind of a couple perks. Number one, I trade my account in an S corp, which is kind of cool. And again, I'm not a tax person, but doing it in an S corp gives you you can use some business expenses against it instead of in your individual account. So that's a little bit tax advantaged. Also, you can trade it in a Roth. So I don't know how many of you have retirement accounts, but if it's in an IRA, a traditional IRA, you keep it being tax deferred. So you only pay tax when you take income out of an IRA, right? A traditional IRA. And if you have options in a Roth, you you get to take all of it out with no taxes. So that's pretty dope. There is an issue, not an issue, but like you want to be aware of wash sales if you're trading inside of a retirement account. A wash sale is like when you and I don't want to get too advanced. I do have other programs that get a lot more advanced with these some kinds of questions, but like a wash sale is like, okay, let's say I own 500 shares of MicroStrategy, and then I sell 5 calls at my average price, right? But some shares I bought here, some shares I bought here, some shares I bought here. So if I take an actual loss on some shares, I can't rebuy those shares within a 30-day period. Otherwise, the IRS says that's a wash sale and they disallow it. It's not that big of a deal. It gets a little confusing in a regular account, but you for sure don't want to do that in a retirement account. So there's a little bit of like nuances, I guess you might say. But I think your main question was like, what about taxes? In answer to your question relative to taxes, you can pay short-term capital gains. I hope this is helpful. I know it was only 2 hours. My throat is super dry. Doing all that talking. I really legitimately hope that this is helpful. I can absolutely tell you without question, and I appreciate all the emojis, love. Oh, do you see the emojis, Nina, as well? I love that. Oh, that makes my heart happy. Um, I really want you guys to see how trading options can literally be life-changing. Join my group on Mondays. I only have a couple people. My Monday group is dope. We just walk through different trades and screen share, and it's Q&A, and it's a really good program. $99 a month, and it's I think it's pretty cool. But anyway, I hope that helps. I thank you for your attention. Thanks for watching. Appreciate it.